Understanding mean reversion, a comprehensive guide. What is mean reversion? Mean reversion is a fundamental concept in finance that suggests that asset prices and other financial metrics, such as earnings and valuation ratios, will eventually return to their long-term average or mean levels. This principle is based on the phenomenon observed in many financial time series, where prices show tendencies to gravitate toward historical averages over time. When an asset's current market price is below its historical average, it can be considered undervalued and thus an attractive purchase opportunity. Conversely, when the market price exceeds the historical average, it may be considered overvalued, leading to an expected price decline. Traders and investors often incorporate mean reversion into their strategies to time their trades effectively. Key takeaways. Mean reversion suggests that various financial phenomena inevitably revert to their long-term average levels. Numerous investment strategies, including stock trading techniques and options pricing models, are built upon the mean reversion theory. Traders use technical analysis tools, such as moving averages and the Relative Strength Index, RSI, to identify mean reverting opportunities. Delving deeper into mean reversion. Understanding the theory. The mean reversion theory relies on the belief that asset prices oscillate around a long-term mean. Historical prices and returns provide guidance for future price movements. The larger the deviation from the mean, the more likely the prices will revert back. This applies not just to percentage returns or market prices, but also to metrics such as interest rates and price-to-earnings (PE) ratios. Application in trading. Investors and traders utilize mean reversion strategies to profit from extreme price deviations. For instance, statistical measures like z-scores assess how far an asset's current price deviates from its historical mean. Statistical analysis. Traders calculate z-scores to find potential trading opportunities. A z-score exceeding 1.5 or less than -1.5 can indicate significant price discrepancies. Pairs trading. This involves identifying two correlated assets. When their price ratio deviates from the historical mean, traders buy the undervalued asset and sell the overvalued one. Volatility trading. Some traders operate under the assumption that high market volatility will eventually return to its mean. Risk management. Traders can use stop-loss orders and take profit levels set around the mean to mitigate losses and secure profits. It is essential to note that the effectiveness of mean reversion strategies can vary significantly based on the time horizon and prevailing market conditions. They tend to perform better in range-bound markets compared to trending markets. Calculating mean reversion. To effectively apply mean reversion in trading, one must follow these steps. 1. Collect historical data. Gather historical price data over the desired timeframe. 2. Calculate the mean. Compute the average price. Text mean equals frac text sum of prices text number of observations. 3. Determine price deviations. Calculate deviations of each price from the mean. Text deviation equals text price text mean. 4. Calculate standard deviation. This reveals price volatility. Text standard deviation equals sqrt frac sum text deviation 2 n1. 5. Compute the z-score. The z-score indicates how far a price is from the mean. Text z-score equals frac text deviation text standard deviation. A z-score above certain thresholds, typically 1.5 or 2, indicates overvaluation, while scores below -1.5 or -2 indicate undervaluation. Mean reversion in technical analysis. Mean reversion forms the basis of various technical analysis indicators. Moving averages. They help identify the average price over specific periods, signaling overbought or oversold conditions when the price deviates from this average. Bollinger Bands. This tool consists of a moving average and two outer bands calculated through standard deviation. Prices are expected to revert to the central moving average. RSI. The RSI helps identify potential mean reversion opportunities. A value over 70 indicates overbought conditions, while below 30 suggests oversold. Stochastic oscillator. It compares a security's closing price to its trading range, signaling overbought or oversold conditions based on its values. MACD. Used to identify changes in momentum, MACD crossovers can indicate mean reversion opportunities. Day trading and mean reversion. In the context of day trading, mean reversion is vital for capitalizing on short-term market fluctuations. Techniques employed by day traders include intraday moving averages, using short-term moving averages to identify potential price reversions on a daily basis. Technical indicators, leveraging RSI and stochastic oscillator signals to spot overbought or oversold conditions quickly. Bollinger Band squeezes. Traders look for patterns where the bands tighten, indicating low volatility and an impending significant price move. Algorithmic trading. Advanced traders employ algorithms programmed to execute trades based on mean reversion criteria. Swing trading and mean reversion. Swing trading focuses on holding positions for several days to weeks, using mean reversion to identify potential price reversals. Key strategies include longer-term moving averages. Swing traders rely on longer moving averages to gauge the average price over a more extended period. Indicators, utilizing tools like the RSI, MACD, and Fibonacci retracements to pinpoint levels where prices are likely to revert to the mean. Candlestick patterns, recognizing specific patterns can signal mean reversion opportunities, assisting in decision-making. Forex trading using mean reversion. In Forex trading, mean reversion strategies help traders capitalize on currency pairs returning to their historical averages. Techniques include moving averages, identifying mean exchange rates for pairs, enabling traders to spot deviations. Technical indicators, RSI and stochastic oscillators are widely used to detect overbought or oversold currencies. Pivot points, these can aid in identifying potential reversal levels, based on previous price action. Currency correlations, historical currency pair correlations can signal opportunities when the price diverges from expected norms. Hypothetical example of mean reversion. Consider the stock of company XYZ. Average closing price over 200 days, $50. Price after positive earnings report, $70. Standard deviation, $5. Calculating the z-score. Z equals frac, 70 to 50, 5 equals 4. A z-score of 4 suggests that this stock is significantly overvalued, signaling a potential short opportunity. Over time, as excitement wanes, the stock price returns to about $52, approaching its average. Benefits and limitations of mean reversion. Benefits. Structured approach, provides clear methodologies for timing trades. Versatile application, applicable across various asset classes and time frames. Effective risk management, stop-loss and take-profit levels can help safeguard investments. Profit potential, profitable under range-bound market conditions. Confirmation, multiple indicators can substantiate mean-reverting signals. Limitations. Market conditions, less effective in strongly trending markets where mean reversion may not occur. Transaction costs, frequent trades may incur higher costs. False signals, short time frames can lead to misinterpretations of market noise. Economic events, sudden news or shocks may disrupt mean-reverting patterns. Lack of direction, non-directional nature may not align with all trading styles. Conclusion. Mean reversion is a foundational concept in financial markets, suggesting that prices will tend to revert to their historical averages. Through various technical indicators and trading strategies, investors can potentially capitalize on deviations from the mean, applying the theory across a multitude of asset classes. However, effective implementation requires awareness of risks, transaction costs, and an understanding of market dynamics. By combining mean reversion principles with solid risk management, traders can enhance their prospects for successful trading outcomes.